All right, today's RBI is perhaps a reason to feel longer-term optimistic about the markets and your money. And we could use that because you know that last year was awful for most of the stock market outside of oil and gas. But did you also know it was one of the worst combined years for stocks and U.S. government bonds ever? That's right. Historically bad markets as government spending helped stoke inflation here and around the world and crushed nearly everything. But if you are thinking long-term, and you should be, declines like last year may actually turn into a good thing. Well, it could take a while. Let's explain. And I'm grabbing this data from Ritholtz Wealth Management's Ben Carson and his A Wealth of Common Sense blog. Always a source of really cool stuff. First up, the ugly. All right, last year was one of only 11 times that a balanced portfolio, 60% stocks, 40% bonds, ended up lower. Usually, one goes up, the other down, or vice versa. That's why so many investment advisors just recommend it. All right, didn't work last year, but 2022 was just so last year. Let's take a look at the future. And in a year, history says, well, things will look better. May not look perfect, though. In fact, 4 of the previous 10 times that both stocks and bonds went down, Carson notes they were also lower in a year. 1930, 1973, and 2001, the combined portfolio actually did worse the second year than the first. I noted that in my predictions for the year, that it's rare stocks go down 2 years in a row, but when they do, the second year tends to be worse. Now, there were some good years like 1974. Overall, bottom line is this: 12 months out, after a decline of both, it's mixed. But look at the right side. 7 years out, you have always ended higher. They note that the average gain of a combined 60-40 portfolio in that time is a pretty nice 65% return. 4 of those years were a combined return over 80%, with the worst year being 1930s, just meager 19.5 jump for the mixed portfolio. All right, some of you may be thinking or saying these numbers don't look or sound that great. But consider that is a mix of 40% bonds. That is meant to keep your capital, not really grow it. So on that basis, those returns do look pretty good. And more importantly, a good reminder that in the game of Wall Street, it is about years, not months. Random, optimistic, and hopefully a little profitable.